Hi, this is Zak Mir from Master Investor, the investor conference on April the 25th in London at the Business Design Centre. I'm starting off with some bulletin board heroes, the first of which is DP Poland, stock I've never seen before or looked at before. Here we have an unfilled gap to the upside through the 200-day moving average around 9.5 pence. That is normally, according to charting rules, a pretty strong a trend-changing piece of price action. And what you would normally say or suggest is that while the shares remain above the 200-day line shown here in black, we should see a decent revival. The target that I'm looking for is probably 18 pence plus, which would be up to this September 2013 resistance line projection. That's going towards 20, but the last resistance here at the end of 2013, 18 pence plus. So that should be on tap over the next 1 to 2 months. If you're cautious on the shares, maybe wait for a retracement back towards the 10 pence zone to cool off the overbought RSI that we've got here. But this does look like at least the beginnings of a decent turnaround. Next up is a stock which I was going to cover last week around the 6 pence level. You'll have to take my word for it, but I read some negative blog about or saw some negative comments on this on the internet and shied away. It probably shows that you should not believe everything you read about stock companies necessarily on a fundamental basis. But the technical reversal here was a clear one. This was an exhaustion gap in January, and an end of day close back above that gap, which was around 6.5 pence, was the buy signal at the end of last week. And since then, we've obviously soared back above former support in October as well. A bit more upside, perhaps, taking us back towards the 20 pence area, maybe the 200-day moving average at 17 pence, the initial target, and then 20 pence after that. This stage really only back below that old October support, which is around the 11 pence level, would delay the upside scenario or the recovery scenario here. Another stock which has been in the doldrums of late, but looks like it might be reviving, is Octagonal. Here we can see that there's been an extended base since the middle of December. The price action for February so far has been a bear trap rebound from below the January low around 0.21 pence and a higher low as well above the December floor, which was well below 0.2 pence. So the view at the moment really is that we could probably head back towards the 200-day moving average. Now it's 0.35 pence. If you're cautious on this, you'd wait for an end of day close back above the 50-day moving average shown here in blue, 0.24 pence, as that has blocked the price action since October. You've just seen these intraday spikes through the line, but no end of day close back above the 50-day line. So that would be the indicator there to go long as a momentum trigger. Finally, we've got Union Jack Oil, which I know is quite a favorite of some of my followers on Twitter. I'm not a follower of the fundamental story here, but I did interview the company one time last year. Situation now is that we've had a pullback from the 200-day moving average. That was the initial technical target, so that worked, if you see what I mean, 0.28 pence. We're back to the bouncing off the blue 50-day moving average at 0.2 pence, and ideally you wouldn't want to see the shares back below 0.2 pence. That was support in November, and we've had enough, if you see what I mean, of probing below 0.2 pence to find support. That was seen in December and January as well. So ideally above 0.2 pence to test the 200-day moving average again, and then finally head back up towards the top of a wide trend channel from 2013. That's it from me. More updates at masterinvestor.co.uk.